Good morning, everybody. We got there. It's Friday, the end of the week. We got through all the central banks, hopefully unscathed. Got a special guest today as well. Mr. Michael Brown is with us from Pepperstone. Stelios is off this morning as well. So good morning to you, Michael, and morning, K-Man.
Morning, mate. Am I the replacement for our friendly Greek friend as he's sunning himself somewhere?
Yeah. Substitute made this morning. Are you doing all right, mate?
I'm good, mate. I'm good. Happy it's Friday. How are you?
Yeah, it's about the same. Yeah, happy it's Friday too. Yeah. Morning, Kay. You all right, mate?
Hey, Ryan. Hey, Michael. Welcome, mate. I'm looking forward to this one. Yeah. So, what was the name of the super sub again? And was that Liverpool in the earlier days? They had super sub every time he came on. He scored goals. What's his name again?
Oh,
Strachan? No.
Wasn't Fowler, was it, when he got older?
No, was it Gordon Strachan also?
Oh, Gordon Strachan. Oh, that's going back a bit.
Yeah, well, I mean, it is back. Hey, don't forget that I was there those years.
I think everything was black and white in those days. Yeah.
There we go, Fairclough.
David Fairclough. There we go. Blimey, that's going back a bit. Oof, really going back with that one.
Yeah.
Anyway, enough about Liverpool. We don't want to talk about Liverpool, considering Mike's an Arsenal supporter.
But, well, can we just avoid football all told? I'm quite enjoying the off season.
I can chat a little bit about Man City if you like.
Yeah, hands up if you won a trophy this season. Me and Kay have got our hands up. So,
I'm off.
Yeah.
I'm done. I've enjoyed the call. Thanks for the invite, Jen.
Brilliant. Right, well, we've got lots to talk about, so let me get stuck into it, and we'll get through all the headlines, and we'll talk about the central banks and whatnot. Starting over in China, and according to the WSJ, China plans a new spending drive and more stimulus to revive its economy, with a ton of new infrastructure spending in the pipeline. A bit of that might already be underway because the China state planner said they approved 14 fixed asset investment projects worth a total of 288.8 billion yuan in May. They're going to look to speed up the implementation of key projects and push forward major infrastructure projects in energy, water and transport. So all still kicking on there regarding trying to stir up the economy. We know we've had all these rate cuts this week, MLF, LPR, so on and so forth, deposit rates. The Securities Times was quoting a Chinese analyst saying that the LPR is expected to be lowered further, and it could be a bigger cut of around 15 basis points versus the 10 pips we had from all the prior rate cuts. I think we're probably at the point where we're getting close to maybe hearing about an RRR cut, which is the big one really, because that releases a ton of cash out of banks' reserves. Perhaps we should be on watch for a bit of a weekend drop of that rate, news of that, or at least early Monday morning. I think it could be coming, and that's something that usually moves currencies like the Aussie dollar. So keep an eye on that Sunday night, early Monday morning. I just got a feeling in my water we've got one of those coming on the way. Although they may wait until they've cut some of these other little rates a bit more, but we'll wait and see. Over in Japan, and we'll start off with the government, and the opposition party has apparently filed a no confidence motion for the cabinet. Cabinet now has, I believe, 16 days to decide what they want to do, whether they reject it. Obviously, Kishida can dissolve the House and move to a snap election, which he pretty much ruled out yesterday, but things can change. So that's still bubbling under the surface there. Probably not too much market moving, because it's likely that he'll win any election pretty clearly. But it just depends on what happens with the opposition, whether they actually lose seats and other parties come into power. There's a whole lot of politics going on over there with the opposition parties. Anyway, we'll keep an eye on that one as it continues. Yeah, go on, mate.
Ryan, the no confidence motion is apparently already voted down. Yeah, we had something earlier today around 8 o'clock.
Oh, really? Oh, I didn't catch that
Yeah,
one.
yeah, it's
Already
probably
been
not.
kicked.
Sorry?
It's already been kicked then, yeah?
Yeah, it's already been kicked, mate.
Okay.
Yeah, move on.
I'll screw that one up and throw it in the bin. Before the Bank of Japan, Finance Minister Suzuki was out saying that with no comment on FX levels and the usual waffle that FX needs to move in line with fundamentals, blah, 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 blah. No change to the comments there. And thus we got the Bank of Japan, which was a bit of a dud in terms of monetary policy and any lines coming out, so unchanged as expected. Now, Ueda, I'm going to compare him to someone who likes to play a prank with sticking a £5 note on the street tied to a bit of string, and as soon as someone goes to pick it up, he pulls it away from them. So his comment started off saying, expect CPI to slow towards the middle of fiscal year 2023. And there's more time needed to meet the BOJ's 2% inflation target. So keeping on the easing path and the dovish side there. Then said expects wages to rise much more than last year. So offering a little bit of a crumb in terms of what might drive inflation. Said we'll continue to weigh the costs and benefits of YCC, keeping on the dovish side. Then he did this little drop the fiver on the string, saying some degree of surprise could be unavoidable, hinting that if they were going to change policy, they may not be able to keep it all slowly, and there may be some surprise for the market. Then he pulled the string by saying the price forecast above 2% may not lead to a policy shift. So another dovish slant. Then he said a big possible shift in the price view could lead to a policy change. And there's the fiver going down again. Then he pulled it away again by saying today's policy impact will appear in a half year or later, meaning that what they've done today, i.e. nothing, potentially means that it won't impact monetary policy or won't impact the economy, prices or anything like that for another 6 months or more. A hint that they're not ready to change just yet. So some little crumbs about if they need to change policy, but otherwise all unchanged, continue easing, and not even a real hint of when they might look to exit. Your thoughts? I'll take Kay first on that one.
Yeah, I was up for the Bank of Japan. So yesterday I prepared such a really nice little roundup of all the possible possibilities, and he just stuck to possibility 1. That means no change at all. And then he spent an hour pushing back against monetary policy changes, and 2 lines saying that perhaps this or perhaps that. The other line that stood out for me is that he says that inflation has not yet or is not yet sustainable, and they still expect it to come back down in the latter part of the fiscal year. He's not only an over-communicator, he's just a Kuroda before any of Kuroda's little surprises. Listening to him, it would be a real surprise if they do something without pre-announcing it. That's what I've been saying already. He looks to be an over-communicator, and seemingly he's not ready yet. And I've got this, I can't keep away from this thought where at the start Suzuki, Kishida, they were meeting and saying they will cooperate. And it looks to me like Bank of Japan now under Ueda, at least for the start of this fiscal year, is just going to let the government finance all those stimulus packages at very low rates, and he's not going to help the yen at all for the foreseeable future.
Yeah,
so that's about it, mate. I mean, there was a possibility, but we still have minutes to come out later, right? I mean, in a while, I don't know exactly when, in a couple of weeks. So they could have talked about something, but so far, what he brings through is absolutely zero for now. Zero, absolutely zero.
Yeah, next week's going to be the first test of this meeting because next Friday we get the next CPI data from Japan. So we'll get to see if inflation is ticking back. Core numbers expected to fall to 3.1% from 3.4%. But it surprised, I think, to the upside every report for the last few months. So we'll see whether he's right or wrong in that one. If there is a jump in CPI next week, that's going to throw some hawkish doubt on what he said this week. So that's one to keep an eye on next week. Michael, were you up for the Bank of Japan this morning?
Was I up for the Bank of Japan? You know, I wasn't going to be up for the BOJ this morning. Obviously had a read through of the decision. To be honest, I'm not really sure why I bothered, because it didn't particularly tell us anything that we didn't know already. And as you rightly say, the press conference was rather dull as well. I think it just reinforces the idea, to be honest, that the BOJ are a long way from considering tightening policy. They are going to keep going with this negative rates, yield curve control, and all the rest of it for some time to come. And in that sort of environment where and I'm sure we'll get onto this a little later on, we had a pretty hawkish Fed decision earlier in the week, the ECB continuing to raise rates, the BOE next week. Why would the yen find any sort of relief when there's scant sign that the BOJ are prepared to even start thinking about, talking about potentially doing something in terms of tweaking their guidance? Yeah,
no, I absolutely agree with that, mate. But though there's been some little language changes, and I would have thought we may have got a few more crumbs towards that, but he seems to have gone the other way again. So we continue to wait and.
He made things worse at one stage, actually, during the meeting, saying that the side effects of YCC are more subdued now. I mean, that actually is even more dovish than they were before. And about the wages, rising wages, I mean, no one should be surprised about that, because last year they were negative, and very negative, the real wages, and this year they got 3.8%. Pay rise, so the nominal wages are going up a little. So he did not give us anything new there either, right?
Yeah, and the problem is we've got to wait another year until we get the next round of wage talks and whatnot.
The one interesting thing, and I don't know when they come out. The next round is going to show the wages for May. They didn't show really in April those increases, but. The main numbers may show a bit more of it, so that may be a bit of interest. But in the meantime, I think we all agree that he's not supporting the yen at all.
Yeah, no, exactly. Right, well, let's move on. Before we get to the ECB, we'll just run over the data from yesterday from the US. Not really anything much to crow about on either side. We had the Empire State manufacturing, retail sales, F.A.C.E, and really, as I say, jobless claims perhaps the bit of a surprise. I was expected to dip to 250, but came out unchanged as last month, 262, up at the highest end of the 200s, not really flagging any major problems. If we start seeing stuff, as Blake mentioned, over 300k, then we're potentially looking at some problems in the jobs market. Nothing much to talk about there. Empire manufacturing, a bit of an improvement. Was expected to carry on being negative, but actually went a positive. This one's been a bit flip-floppy of late, but a small up on that one. Philly Fed was a bit worse than expected. So as you can see, mixed numbers, one up, one down among the regionals so far. In the different components, again, not really much to look at. Employment was negative, but not as much. New orders, negative, but not as much. Prices paid, up a little bit. So, nothing up, nothing hugely down. Bit of par for the course, what we've seen from the data. Again, with retail sales coming in 0.3, not busting any big numbers, but was expected to drop. Core numbers up 0.2. We're all looking 0 points, 0 points, 0 points, which keeps things ticking over without doing anything really good or really bad. So we can skip over the rest of that data. And let's get into the ECB then. Well, pretty much went as expected, coming out with a 25 pip hike. and keeping a hawkish bias overall. The main thing that happened was that they raised CPI forecasts, all their CPI forecasts, but only by a pip. Now, why is that surprising? Well, in March, they actually lowered their CPI forecasts from December, even while core inflation was continuing to rise. Headline inflation had been coming down. I think it was from 9.2% in December when those DEC forecasts were to 6.1, I think it was, when the March forecast came out. So they lowered all bar one of their forecasts then. We've seen nothing but inflation coming lower since then, although the core's still sticky, and they actually raised those forecasts. As I explained yesterday in our chat room, that's their version of the dots. That's their higher for longer message. Raising forecast by a pip doesn't do anything. We're seeing swings of half points, 8 points, nearly 100 points in CPI numbers these days. So moving them up a pip isn't a big move, but it is a message. It's a message the ECB are saying, we expect inflation to be sticky, and that's the reason why we're going to stay hawkish. And that came out in the comments thereafter. Lagarde said manufacturing continues to weaken and services remain resilient. That's acknowledging what we've been talking about for the last few weeks. The labour market remains a source of strength. Wage pressures increasingly important for the inflation source. And longer term inflation expectations warrant monitoring. Then she got into the real nitty gritty, saying we still have ground to cover. She said, are we done? She replied, no. Then she said, we will likely increase in July. So firmly keeping July in the mix. No sign of reversing at all at the moment, and September's on the table as well. Now, one thing she did say that stuck out, and she's been mentioning this in previous press conferences about the energy support that states are giving. And she said states should roll back energy help or risk further medium-term price pressures. Now, that's a bit of a repeat, but it came with a note or on the end saying that if there were medium-term price pressures, that would call for a stronger monetary policy response. So she's basically saying to member states, if you don't start pulling back on the energy help you're giving people, you're going to create inflation. That's going to cause us to raise rates more. So a little bit of a laying at the feet of governments on that side. She said, barring any material change, it's very likely that we will continue to raise rates in July. We are not thinking about pausing. We haven't discussed or thought about skipping or pausing. And then in another wagging finger at the doves, she says, I do not want to comment on a terminal rate. That's for markets. And the reason she said that was because if she puts a number on a terminal rate, that gives the doves something to target, because if they know how high we're going to get to, they can start trying the old pivot trades again, and when rates is going to start coming down. So throughout all of that, hawkish, stay in the line, not yet ready to pause in any way, shape or form. We likely getting a July hike. September is well on the table. We've had a few ECB bods out this morning talking along the same lines. So as far as the market's concerned, the ECB is going to continue. Now, after that, we got the usual sources piece, and one of those included September, and Reuters piece saying that the ECB are set for a summer debate over a possible September rate hike. And then later on in the evening, we got another interesting story, again from Reuters, saying that ECB policymakers are beginning a debate on evening out the interest rate corridor. Just to tell you what that is, the ECB has three interest rates: deposit rate, which is at 3.5%, the main refinancing rate, which is at 4%, and the marginal lending facility, which is at 4.25%. Now, up until 2014, all these rates were the same level because of the ECB and what they wanted to do with easing policy and injecting money and all that sort of thing. They split the rates up into different bands. These all have different durations of duration as to which money can be parked at the ECB and whatnot. So what they're looking to do is narrow the corridor between 4.25 and 3.5%. I'm assuming that that ratio remains the same going forward. That can be seen in two ways. A hawkish move in narrowing that corridor would be taking the lowest rate up towards the highest rate. Therefore, you're keeping a higher rate in place. A less hawkish move would be doing the opposite, taking the highest rate down towards the lowest rate. So this is something potentially we have to look forward to, maybe when they get near their peak rates, if they don't change things sooner. That could be a last hawkish throw of the dice if they take the lower rates, i.e. the deposit rate, up towards the marginal lending facility, because that's then potentially pushing rates a bit higher than they are now. That's the ECB. Over to you guys. Who wants to have their 10 pence worth first?
I'll let our guest do first, but just on this quick on this ECB corridor thing, I've read the article as well, and it does look to me like they are perhaps a little worried about not reserves, but scarcity. So reading through the article, it could mean that the higher rate is coming down, or we converge more towards like the middle point, but I don't think they will use it as a hawkish. That's my 2 cents only, you know. But I don't think it's meant to read in a hawkish direction, because they were talking about the scarcity and the rates now being higher. It's probably not needed that you keep rates as high on the top end. That is how I read it anyway. But then, Mr. Mike, go ahead.
No, I was going to say it's an interesting one. I hadn't actually read that story myself, but it's something that, you know, hasn't really been on anyone's mind in terms of narrowing that rate corridor. I certainly haven't seen much discussion about that over the last few weeks and months. So it's interesting that that's suddenly been planted in the press. I think the ECB more broadly is very much in keeping with, well, certainly what Ryan and I were discussing earlier in the week, where, you know, the real interest with the ECB comes in September. Lagarde didn't pre-commit to a July move, but pretty much guided as concretely as they're ever really going to that we're going to get another 25 basis point hike then. And it's really then a question of, do they go again in September? And I think you're already starting to see this kind of tug of war, or this battle between some of the hawks and doves playing out now. And we've got 3 more months of this to go, because we've had a lot of ECB speakers already this morning, you know, as you would expect. The German central bank president say, you know, very hawkish, putting a September hike on the table. Some of the others a little bit more dovish, a little bit more cautious, saying that it's far too early to have that conversation. And I'm still very much of the view that we'll probably end up in a place where, if we get a September hike, and it feels silly to be talking about this given the sheer volume of data that we've got coming between now and then, but this is the narrative that the market's going to be trading. I think there's really 2 ways the September meeting can go. Either we get a hike and it's a very, very dovish hike from the ECB, or we get a pause or a skip or an end to the hiking cycle, whatever you want to call it, but that comes with some concessions for the hawks, and it's, you know, around the balance sheet rundown or something like that. But, you know, in terms of what the ECB announced yesterday, probably not too surprising. I'm not entirely sure there was much in there to make the euro rally a whole big figure, but there we are. You know, the market is not necessarily a logical beast at all times, but certainly I think the ECB are getting towards the end of the tightening cycle. I think we've probably got 1, maybe 2 more hikes in the tank at the very, very most.
Yeah, exactly, mate. Exactly. I mean, I'm not surprised to see the euro up here. I just had that feeling yesterday, all through the ECB and seeing how it came through the Fed and everything else, and it just looked like it wanted to go. Unfortunately, I wasn't in it. That's the worst part of it. I was looking for a decent dip over the Fed and the CPI data to get some on, but I didn't, and I don't like chasing. But yeah, I'm not surprised to see it. There was a very high bar to see the dollar rally in any way, shape, or form this week, and you know, apart from dollar yen, that's been the case, but that's been more yen than dollar. So not surprised to see that. Anyway, Kay, your thoughts on the ECB?
Well, first of all, I must say I was half wrong, because I thought Lagarde would start to shed a little bit of her hawk wings over the presser. So that hasn't materialized at all, and that I think is part of your big figure higher in the euro dollar after the event. Yeah, so the rest of the expectations were pretty much there. I mean, the hike and leaving the door open, but she didn't only leave the door open. She nearly pinned well, she did actually pin the July hike on there too. So in that respect, I think the market was perhaps a little bit hopeful, or speculating that she may start to be more neutral, or picking up the dovish, not necessarily dovish, but more neutral, because she has been in the Hawks camp now for a good few months. Yeah, so that's where your big figure comes from. So I was, to me, it was, let's say, half a surprise that she actually kept her very hawkish tone. Now, yeah, so the market took it as we had a pause of the Fed, we had the ECB hiking, and the ECB hiking clearly saying that they are going to continue, where the Fed says we don't know. And that's also what happened then. I reckon that the market, or maybe the bigger players, were waiting for both meetings to be over, and to then give the dollar a decent slap, and then buying euros as well. But then it's quite funny that apart from yen, the rest of the euro crosses has not really followed. So it was really a dollar move. Well, I mean, euro CAD is a bit higher as well. I mean, the stuff in the oils and gas can do strange things, but it's mostly a dollar move, right? So, and that seems to me that the people were just waiting for both meetings to be over, and then give the dollar a slap. And we also saw paradoxically, is it how you say, the US yields coming off a little bit post meeting. So I really reckon it's a case that people were waiting, and as you say, you were expecting it, that the dollar comes off a little bit. But then her being so hawkish, I'm that surprised that we don't see more euro crosses being higher. If you look, for instance, at the euro sterling, it's actually lower, and so that is a bit well, I mean, that's Bank of England, of course, in there, and the data in the UK. But we could have expected that after Lagarde, all euro crosses would be higher, but that is not the case. So it's been a dollar move.
Yeah, very much. And I think, yeah, I think it's good. So where is the end of all this then? Is it September?
Yeah, I guess Mike said it there. July is pretty much nailed on, and then September is going to be the big decision time, probably.
Yeah. So what we're looking at rates? What are we looking at rates? Probably 4%-ish, 4.25%, depending on which one we're looking at. Is that a fair level, do you think, for the ECB?
I reckon so. I reckon so. But I mean, we will see how sticky inflation will be then, and how those data are moving, because we saw a little bit of weakness, especially in the German data coming out over the past weeks, and that's going to be they should start to look at those kind of data as well, barring inflation. But for the time being, inflation is still sticky. So yeah, so the main interest rate is 4%. We could be looking at 4.5 if they do 2 quarters, or they could go to 4.25 next meeting, and then December will be where it's all about. September, sorry.
Yeah, no, I agree with that. Mark saying Alice are talking about a peak at 4%. I think that might be the deposit rate. A lot of people tend to look at the deposit rate when they're talking about peaks, Mike. So again, you have to be careful to make sure what rate they're talking about, because we're already at 4%. In the main rate, and they're thinking of going in July, so we're already above that 4%. But the deposit rate at 3.5 would suggest that that's the peak they're talking about on that one. And then we might play the game of narrowing the corridor, or bringing all the rates in line again anyway. So in one way, shape or form, there's going to be a rate hike or a rate cut outside of rate hikes and rate cuts, if that makes sense. But anyway, we'll deal with that when it happens. So the euro in general, we've had this breakup. 109's toast. We had a level at 109.3540. That's toast as well, and it's trying to build support there at the moment. We've got a bit of resistance here around the 130 at 109.60s. As you can see there, just we had some prior action going in along there. The next number for me is the big figure 110, and then if we get up towards these highs, 105, 110 and a half, 110.70, that sort of area, and then we might have a crack at 111. Can we do that? Have we got room to move up there? I think there's a case to say we could have a move up there. Can we break it? That's a different story. If the Fed are on pause for now, and if we get any inclination that July hike isn't going to happen, then I think that's going to give us the legs to run this up to that 111. In between, we're going to be trading the data points. We've got Michigan sentiment later on today. That's about the only US data for the day. Not a huge number, but in this environment, just after the Fed, where we're going to be looking to see whether they're going to be right or wrong with a pause, this data may be a mover later on. So keep an eye on that one.
The other one, sorry, just to
on,
jump in there. Now that the fire alarm has stopped ringing in the office and I can actually talk again, I was going to say the thing with the University of Michigan number for me is not necessarily the actual sentiment figure itself. It's those inflation expectations.
Yeah.
That's what's really worth watching, particularly the 5 to 10 year inflation expectation, because I think that on the last read when that survey came out in May, I think the longer run expectation was its highest since 2011. And of course, that is the problem now for policymakers. It's there's signs, at least in the States, not necessarily here, but at least in the States, that inflation is starting to move lower. The problem is, do we now get to a situation where those longer term expectations have risen to such a degree that you end up with these price pressures almost getting embedded within the economy? And I think that's going to be something very important to watch as we move through and debate whether or not the Fed are going to be pausing in July, hiking in July, skipping again, whatever it may be.
Yeah, Mike, I think, Michael, you're absolutely right in that. We had a few months there around the turn of the year where the longer term inflation expectations went below 3%, and now it's the second or third time that they are above 3% again, and actually increased by it's again 10 basis points, but it's not a lot, but those kind of expectations may indeed play a role, right?
Yeah, agreed. And Mike's just asked, can we see euro dollar reaching 112?
So can we just discuss your chart first, Ryan?
Oh, pot kettle, mister. Don't worry about my chart, Sonny Jim.
And you haven't seen anything yet. There's a few specialists in our chat room who have much worse than that.
Yeah, even Kay used to take the mick out of my charts, and he's overtaken me with the colours. So yeah.
Calm down. It's Friday. Calm down.
You'll see them in a minute. Anyway, enough about my charts. Thank you very much. 112. Yeah, it's possible. I think it's going to take a lot of goings on the dollar side rather than the euro side. But you never know. You could see inflation accelerating in Eurozone, data picking up. I don't see it. I think 111 is going to be a decent enough level. You can see it there. It goes all the way back to last year. So 112 is a big level as well. We had a break there, and it became solid resistance. So these are big levels we're getting into. The question is, we're talking 25 pip hikes here or there. Have the ECB got 2 more in them? Have the Fed got 1 more in them? 25 pip hikes aren't worthy 200-300 pips or anything like that. So it's gonna take some work to bust up through these levels in the euro. And as I say, I think that's going to come on probably a weaker dollar rather than a stronger euro. So it's all going to be led by what goes on in the Fed. And of course, as we've been mentioning for weeks and weeks, the next big trade we're going to be playing with, or expectations, is when they start cutting. And then we're going to play the central bank monetary policy divergence the opposite way. Who's coming down fastest? Who's going to get to neutral fastest? Where's neutral going to be? We've got all that to come, and I think we're probably going to be start playing that in the latter part of this year. So we've got a while, but we can get positioned. If you want 112, you got to get through 111. If you can't get through 111, what are you going to do with that? You're going to keep buying it up at 111, hoping for 112. Are you going to think, well, we've got a solid level here, so maybe try the other way and see if we find a bit of a range, maybe back down to the 108s, 107s, something like that. Just to show you a clean chart, we are messing around with a bit of a trend line that's been a bit of an on-off trend line. It goes all the way back to 2017. So that's something to keep an eye on just for this, because if we get a move above it and we manage to hold it, it could find it's a bit of a level of support, and then we might get a further move up. So it's a bit of a longer term chart to look at. Going to look at euro sterling, because this is one I did want to play between over the ECB and managed to get some in, although it didn't give us much of a jump. I was hoping we might get a look up at 86, even as a bit higher. I would have loved anything up to 87, 86.50, that sort of area. I would have jumped all over that. But in the end, I just had to take some. I got in at 76 and a bit more at a bit higher up, 85s, I think it was. Kay, you got in some of this as well. We didn't get the rally like we did in the euro dollar, did we?
I was honestly thinking, listening to Lagarde, she went on, that we would go up to 86.5. I really was thinking that we could get there. So that I've only sold small up there on that rally, thinking that give me 86.5 and I'll give it a good kick in the goalies, but never been up there. So yeah, we have to take what's given, what's in front of us. Have to do it with the smalls sometimes.
Yeah. No, I was saying 68 and 85s I got in at yesterday. I just had to put some on.
Yeah.
I had FOMO from missing everything else this week, so I had to chuck it on. But we need to get through this 35-40 area.
And I'm sure you're going to ask, but I just wanted to have Mike's view on what's going on in sterling, and not only price-wise and expectations for the Bank of England, but while Mike's here, do you have any opinion also about anything that could affect the sterling, perhaps more on the political side with Sunak, Bojo and stuff going on? Do you have any expectations around that as well? It can be only like a 1 minute. If you just say no, that's fine as well with me. But so I mean, a bit of an overview, if you can, if you would have.
Oh dear, you're going to regret asking me about the UK, and keeping it within a minute is going to be a problem, I think.
Okay.
Let's do it. Start the clock. Let's do it quickly. Politics, I don't think it's a story yet. Obviously, we are, as we all know, probably 18 months, 2 years away from an election here in the UK. We've got to have one by January of 2025, probably in autumn next year. So the sterling doesn't care about politics at the moment. It will, I'm sure, as we move nearer to that eventual election. But certainly at the moment, that's not really a feature. I think that's just noise. As you said, sterling's had an incredible rally this week. The long-standing resistance, if you look at cable 126.80, we've blown through that and haven't looked back. And if you look at the charts, I'm sure Ryan's got a chart with 1 million lines on it. One of them will show that there's not really much in the way of levels between here and 130. Mm-hmm. So we could really start to push higher just on a pure momentum play. I don't think, though, that if you look at what the rally's built on, personally, and I know I've been the most bearish man in the world on the UK for some time now, you know, the market, as someone popped in the chat a second ago, is pricing in roughly a coin flip that the BOE get to 6% in terms of bank rate. I cannot see that happening. You know, if they're going to raise rates by 25 basis point clips, that means they're going to hike all the way through until February of 2024, which, you know, quite frankly, the economy is going to have headed south a long time before then. So I think the market's going to be disappointed in terms of its BOE expectations. You've got a labour market that's far too tight, inflation that's running far too hot, and almost absolutely no economic growth. I think we saw an expansion of about 0.2% in April. We'll give all of that up in May because of the extra bank holiday. There's just really not a lot going for the UK at the moment. But at the same time, would I short cable? If you'd asked me this time last week, then yes, absolutely, and I'd probably now be crying in a corner somewhere. Would I do it now? It's a bit of a tougher case to make, given that you know we're in this kind of technical no man's land almost.
Yeah, and there is momentum behind the sterling right now.
Yeah, exactly.
I do think, though, if you look at the way cable behaved, so there's a partial dollar play in there as well. We're seeing across the board. But the reason why euro sterling as well is lower is this, there is a bit of positive divergence, I would say, in the real data compared to European, or compared to other parts of the world as well, which are supportive for the sterling right now. And well, people listening in here and people in our room know I'm been quite positive on sterling for a good while. I do think it's supported not only by Bank of England expectations, but also what the data are showing us now. The million-dollar question is, of course, is it going to last? But as you say, and Stella actually as well was talking about that, there's little standing in the way to print the 130 on the cable, perhaps even into next week, until the next CPI print. Because imagine next Wednesday CPI comes in 1% lower, then it's turn that ship around, I'd say.
Yeah, I personally think there's a fat chance of that happening with the CPI.
Mm-hmm.
It may come down, probably will come down. I wouldn't be surprised if we saw some upside numbers in that as well, the way inflation's been going. There really is no let up over here in what's going on with prices at the moment, particularly food inflation.
Yeah. Oh, sorry, I was just going to say on inflation, you forget the headline number. You know, that is just going to keep coming lower and lower and lower, but it's all mechanical. It's all because of the slightly wonky way that we set energy prices here in the UK, and also due to the pretty tough annual comps from last year, that base effect is going to drag things lower. So what we really need to start looking at is, well, firstly, the core number. So you take out energy and you take out food. That is at a 30-year high of 6.7% and doesn't seem to be showing any sign of wanting to come lower anytime soon. And the other thing is you start looking at things like annualizing the month-on-month prints, or the 3-month average, or whatever it may be. And that's how you get a kind of truer read on what inflation is really doing. But I don't think any of it is going to be particularly good news. Let's put it that way.
Yeah, but core inflation, I'm just looking at it now. Core inflation is expected to dip to 6.7 from 6.8, and headline to 8.5 from 8.7.
Oh, there we go. Let's pop the champagne.
Yeah, both measures expected to come down, but you know, I think it's a coin flip. Whether it comes down, stays the same, or goes up again. I certainly don't expect to see a big drop more than expected on those numbers. And what Mike's failed to drop into the conversation is that the likelihood of him buying me lunch when the BOE hits 5%. I know he's kept it quiet on that one.
I have.
Some time ago.
I'm still feeling yesterday's lunch. I can't think about buying you lunch.
and it's not going to be a McDonald's lunch, I'll give you that. Anyway, Kay, do you want to have a quick look around? I know you want to show everyone you had a great trade in that guppy, and what's expected next. So thanks,
mate. I'm just going to show perhaps a few of those yen pairs since we had Bank of Japan on, right? And I'll have a look at sterling perhaps as well. So yeah, first of all, you know, this sterling yen. We came very close here to the 78.6 of the whole move lower from 20, where we came there. Actually, we pinned it. From the 2015 all the way down to 2020 move there, and then in the shorter term as well, we had some activity up here as well, and that's why I decided to take this trade off. I've been on and off in this trade from around here, actually low 70. So that's I think I missed a big figure on the way up, but the rest was pretty okay. And I decided to take it off today because I had what I wanted to see from the Bank of Japan, and then we had this acceleration, and it's a pretty decent target. And if we look at back in time, it's a pretty decent target. Now, some of us in the room and also in the market are looking at this kind of extension. If you look at it from a technical point of view, there is also, is this on the weekly or so? Yeah, there's also a possibility that we are going to tag before inflation comes out next week. There is a possibility we are going to tag this 184 as well, which is the 50% of the whole global financial crisis, plus a bit of European crisis weighing on all yen pairs, and including the sterling, because then we were still in Europe, as one can remember, until here. So there's a few really decent levels on the horizon in this sterling yen. Can it break? Of course. I mean, technicals are just what they are, pictures, and the market decides what to do with a pair, just because there are more buyers than sellers, or vice versa. But to me, that was a decent enough target to reassess a little bit, and see what's going to happen next. So that is me done for that trade for now, and I don't know for how long, because if we really start to, or if we get a decent setback towards the end of the week, or today, or early next week, I may decide to re-enter it, because let's face it, I mean, UEDA is not giving the dollar bulls anything at all, right? Anything at all. And but if we look at the dollar yen as well, and we are close to here the upper trend line of this channel or wedge, however you may call it. And we are running into interesting zones here, levels here as well, up in the 142s. There, I'm just playing around really. Earlier this week, I bought a call when dollar yen was around 139. I bought a 140 call, and I've been trading my option around. I mean, both on the ECB and on the Bank of Japan. I tried a long dollar via options. So people in the room know that on the euro dollar, I bought a bit of a put, but that was like just at 20 points risk, which is okay. But the dollar yen has been pretty good, because since it broke above 140, we haven't really looked back too much. So I'm trading this around, and I will respect levels up to 142, 142 and a half versus my call, because also we can't deny that the dollar itself is not doing too well right now. So in the longer term, can we go higher? Of course we can go higher, because the radar says not to buy yen right now. Is it going to go straight away? That's going to be depending on the dollar. And today, and that's why I hedged quite a bit of my option now. I'm over half hedged today on those Michigan data. If we get any weakness, and looking at how the market's been trading the dollar this week, it may be that the dollar could have a tough time finishing the week. So here we are on the cable. Also earlier, we've broken above this line here. Well, the 126.50.80 as well. But we're breaking up, and there's very little reason to be really short. We're even breaking above the 61.8 here. So cable is a bit of an animal right now, and I wouldn't look for a reversal for as long as we're above 126.15.60. Really, this zone here should be support right now. And as we were talking about, there's not too much standing in the way of having a look at 130. For that, we will need some more weak US data, and that could be the accelerator for this move. And then, you know, 200 points in cable. Cable is a faster mover usually than the euro. It could be a matter of a couple of days. You know, we could be there even before the next round of CPI data comes out next Wednesday. So be a tad careful. If you want to counter trade this cable, I'd rather wait for it to start moving lower than going to stand in front of it right here and now, to be honest. Yeah, Ryan already showed that euro sterling a little bit different look. This still looks to me like you could put a bit of a line here as well. Still looks offered. I was hoping that it would break a little bit above this zone, go into the 86.5 and then come back lower, kind of a false break of this trend line. We even didn't get it. We had to be satisfied with just a very, very shy test of the upper line here, very, very shy, and it's already back down. It's probably going to be a slow grind lower if it has to go, because Lagarde was hawkish enough to hold this one from falling out of bed, but I still think it's oriented a little bit lower, down to low 85s, and then we will see what goes on in this one. What else? We got a couple of interesting levels also on the commodity currencies. Have a look at this, 68.90 on the Aussie, tagged it, and well, went like a couple of points through, but tagged it and really capped right now. So this is going to be your level for this afternoon, I think, when the Michigan comes out on the Aussie. We did have that surprise rate hike. Aussie did very well since then. Yeah, so that's the level to look out for. 68.30.35, and then 68, call it 05.15, is going to be your zone, the prior high here as well. If that starts to go, that means that something has told us that it's no time to be short dollars anymore. So I'll look for that lower zone here actually after the to end the week or after the Michigan. We've got similar picture on Kiwi. Kiwi is trying to make up its mind around the 61.8 here, 62.30.35. Had already several tries to break above, and we're hanging around. I guess that's going to be your level to monitor for the end of the week and start of next. If we hold it, if we get above and hold it, we should be on our way to 62.75, perhaps 63 the figure. Yeah, 63 the figure is pretty reasonable. Have a look at what's the prior top here before the big decline. So if we hold above, this could be the target around 63. On the other side, if we start to turn around again, then we are going to talk about our famous 61.85.95 again, or 61.85 figure, where we always had a bit of interest in the past as well around there. So that's going to be your level to the downside. What else? Noki, it's a bit of a strange one. I thought that we at least should come and test this support here, and that later springboard for the last leg higher, but we can't get down there. Probably has to do with oil and gas. as well, and Norges Bank is still selling Norwegian kroner every day, at least until the end of this month. I was hoping for a little bit of a test here, a serious test, to make a decision on this Norwegian kroner, but for now it's undecisive. I'd buy I'd catch a knife here, but it's really undecided. On the top side, if we get another test here of those low 1170s and fail, then I think there could be more to come, but we may have to wait. Next week is Norges Bank, by the way, and some of the Scandinavian banks are thinking that they may go as far as a 50 BP hike, which is not in their playbook, but they may do it because their inflation was very, very sticky in Norway. Dollar NOK, for those who trade dollars, we are on support here, 1047, 1050. Keep an eye on that for the close of the week. Keep an eye also if we would get a retest of 65, 68, what's happening there. If we break under this zone, then we're probably on our way to lower 10 and a quarter or so in the dollar Norway. But I've got little of a view here. And the thing I was talking about yesterday are those emerging market crosses. It does look like some of the carry traders got a little bit cold there, and we saw this spike in the euro mix. Keep an eye on what's happening around 1870, 72 at the close of the week. The longer termers, they are still pretty much sleeping on both ears. Those who have been short, taking the carry for a long time, they've had a double push. Not only did it come lower, but every day they're getting money. Same could be said about the mix yen, of course, even more. But even on the euro mix, I don't think the long termers will be worried for as long as this stays below 1940, 1950 or so, because they have been taking a lot of carry so far. But for the short termers, these 1870, 72 could be interesting enough for the end of the week. So hold it, then we may start to push up in the high 18s, possibly low 19s. If in turn we start to lose it again, the mix is still very popular, as we know. If we start to lose it again, then we're probably going to go back to retest the lows. I think that's good enough for now, Ryan. Back to you.
Thank you very much, mate. I'm just going to grab the screens back very quickly before we finish up. Can you see those okay?
Yeah.
Yeah, cool. So for all you loony lovers, and this is also a lesson if you want to be trying to pick tops in cable. We had this breakdown. I'm a little long down into here, 37s and 13s. If you want to try and pick bottoms and pick tops, this is the sort of price action that gives you a bit of hope. You make a low, you bounce, you come back to that low, you hold it. You know, we may break down in this one, and if we do break down, I think we're probably going to see the next big level down at 3080, which is another big level. We've got a lot of empty space here. But if you want to try and do the same in cable and pick some tops, look for confirmed price action. So in cable, we've had a high now up here. If we test that high and hold it, that gives you a bit of a signal to try some shorts. If we break that high, even by a few pips, it tells you we're not done. All you want to try and do is stay in the trade as long as possible. So that's my play for that one. And just back to euro sterling, I'm short this one. I wanted to short hawkish ECB to run into the Bank of England. I'll be looking for the low 85s to take some profit on that one. I think if the CPI comes in strong, we should probably get that. If the Bank of England is strong after that, we may get that. But then that's when I'll start to look to take some profit and locking in the rest, because the market is already starting to get a bit extreme on where rates are going to go for the BOE, as one of the rumors just said, looking at 6%, some people, Mike said. So, you know, that's probably getting a little bit toppy in terms of expectations. And that means that the market's probably pricing that way. And then we can't go much further than that. So down around 85s, 84.80s, that's going to be a big level to watch into next week, where I'll be looking to take some profits. On that note, thank you very much to our substitute and welcome guest, Michael Brown. Thanks for coming in, mate. Any last thoughts from you on the rest of what's to come today, or
the rest of what's to come today? Well, I'm
Yeah.
hoping markets are quiet so we can sit back and watch the cricket, aren't we? But yeah, it's going to be an interesting week next week. BOE next Thursday, obviously. The other thing that I don't think has been mentioned is that Fed Chair Powell is making his way to Capitol Hill for some testimony next Wednesday and Thursday, I think it is. But, well, exactly. It will be like watching paint dry. But I think it could be quite interesting, just in a context of, since the FOMC, I would argue markets have probably moved in the opposite direction to where Powell would have probably wanted them to go. You haven't seen Treasury yields manage to sustain that rise. Stocks are a little bit firmer. The dollar's a little bit softer. So the market hasn't really reacted to that hawkish revision to the dot plot. And I just wonder whether Powell is going to really try and ram that message home when he speaks on Wednesday. And as a result of that, we might perhaps get a little bit more of a hawkish message there, and that could inject a little bit of vol into things. But yeah, they're the two things I'd be watching as we move into next week. This is going to be famous last words, but given the lack of any news, the lack of data, the fact we're going into a long weekend in the US as well, my expectations are relatively low for excitement throughout the rest of the day.
Yeah, no, granted on that. And yeah, I didn't want to say it, but I'll be tuning into cricket a bit later as well. Anyway, that's all for this week. A really busy week. I hope you guys and girls have done well with your trading and not made any big losses if you haven't. Thank you as always to K-Man, and I'll thank Stelios for his input. Thanks to Michael for popping in. Thanks to all you folks for supporting us on the Flow Show. Have a great weekend, everybody, and we shall see you all bright and breezy on Monday. Take care.
Thanks, Ryan. Thanks, Ryan. Thanks, everybody. Have a good, safe weekend, and be careful for the witches, okay? It's witching day today.
Cheers, gents.
Cheers.